Thanks for watching, everyone. For our latest Artemis Live video interview, I'm delighted to welcome back Niklaus Hilti, Head of ILS at Specialist Investment Manager, Credit Suisse Insurance Linked Strategies. Welcome, Niklaus. Great to see you again.
Thank you, and thank you very much for the invitation.
Sure. So it's been a particularly busy time since our last interview, Niklaus. There's a lot going on across reinsurance, the insurance-linked securities market, and of course broader in the capital markets as well, which affects these industries. So I wanted to get your views on market dynamics and also some specific market segments as well. Still going through a particularly challenging renewals this mid-year. I think even Florida's not yet closed down for some people, and obviously there's the July 1st renewals as well. Rates for catastrophe exposed contracts are approaching some at least decadal highs, if not more. And cat bond spreads have been very, very wide and seem to be persistent in that respect as well. So I'm hoping Niklaus can shed some light on how Credit Suisse is viewing the market at this point in time, and also what we should expect for the second half of the year. So to begin, Niklaus, perhaps we could discuss how the macro environment is impacting ILS and reinsurance this year. Maybe you could talk us through the way sort of market dynamics have changed since January in your review.
Yeah, no, definitely. I think for a long time, I think it's the first time that macro is actually having a significant impact on the market. I would say the dominating topics are strength of the US dollar. I think this is something I would say, especially in the ILS market, where a significant proportion is most likely coming through euro-denominated investments or investors, having an impact on capacity. We believe that this might be a little bit a driver for how much capacity is available in the cat bond market, given the strength of the US dollar, so maybe a little bit less capacity available. And on the other hand side, we believe also it has an impact on secondary market liquidity. We saw there has been significantly less buyers over the last couple of weeks, months, and the market, I would say, dried up for quite a long time now and for quite a significant time. It's not the only driver, but it's definitely, I would say, an additional factor impacting the dynamic of the primary and secondary market on the ILS side. The other thing is, of course, the inflation. I think inflation is very significant if you measure inflation. If you look at, for example, home building prices in the US or generally building prices, be it from labor, be it from the material side. I mean, we look at very significant numbers. I have to say is, in my career, I haven't seen that. Our data, when we look back, for example, to the beginning of 2021 till basically now, we see in certain areas, we see 40% inflation of these, let's say, construction and therefore potential claims inflation costs. And that is significant because, again, if you think about a new placement on the reinsurance side, on the cat bond side, if you try to price it adequately and you try to look at what is your risk-adjusted margin, today you have to factor in, maybe since the last model version came out till today, you have a very significant claims inflation. That means if today a hurricane, an earthquake, whatever event happens again, a historical one, it would be significantly more expensive than what is captured already in the most updated model version. And then if you, for example, look at cat bonds, let's say a 3-year placement, you have to think as well is like, what's the claims inflation over, let's say, the next 3 years? And I don't personally believe that we will see the same pace, because nobody could afford to build a house anymore, but it's something which needs to be factored in, and that raises the question of how adequate is the pricing, or how much did we really see a real increase of margin or premium with the latest premium increases. For us, that is the most critical question at the moment. So really, I would say FX and then interest rate. On the positive side, I think it's of course the macro environment is influencing, I would say, the attractiveness of ILS. ILS proved to be low correlated again in what I would say is a crisis in the financial market. We saw that already with the Euro crisis. We saw it with the global financial crisis back in 2008-9. And I think now we see it again, that it is holding up very well in terms of returns. And then, as we all know, raising interest rates is actually a positive thing for ILS, given that our total return will increase with the floating structure these investments have. So I would say that's probably on a relative basis from an investor perspective. I think the last couple of years, when you make 10, 20, 25% returns on the equity side, almost consistently, I think low yielding ILS was a little bit less appealing. And I think now I would say there is definitely a very positive momentum from what you asked, like the macro environment. But I would say claims inflation and inflation, that's really what we need to keep an eye on from a risk adjusted perspective.
No, that's some great points there. Thank you, Niklaus, and particularly that one on sort of claims inflation and how reconstruction costs are going to be just very, very different going forwards, it seems. I think that really could be a bit of a shock for some in the industry, particularly on, as you pointed out, transactions that were priced more than a year ago, where inflationary effects have been so significant ever since. I mean, these macro dynamics now look like they're set to continue for a good while. We've had more interest rate increases this week in both the US and the UK. Do you think this is going to be an influence on the market all the way through the second half of the year?
I think from our perspective, there is a high probability that these topics are dominating the financial market for longer. And I would say the element we probably understand best, which is the whole COVID topic. I think from that perspective, our view is that if China continues with a zero COVID strategy, or other countries continue on such a strategy with the new variants, which are spreading much faster, it becomes harder and harder, and lockdowns have to be tougher. And that is why we think from that perspective, it could basically last longer than we all thought. And I think, like, we live in an environment where we probably since weeks or if not months have no constraints anymore. And I'm afraid with the new variant, it seems like this could drive global supply chain for quite a while. And of course, we don't know what the development will be during the cold winter season. So we will see that as well. But I think that's already one driver. And then I think economists, I think the big question is, of course, the war in Ukraine, the whole topic around energy prices. My personal view is there's some potential for further escalation on that one, especially again in the winter time. Also with the latest gas supplies into Europe, to me that looks like this could keep us busy longer than we all want, and have an pressure on inflation for longer than we like. And then last but not least, I think then the question probably is for secondary effects, where like basically salaries will increase and you get the typical inflation spiral turning. And that is then the question is whether the time is so elongated, where we see the pressure on the energy and supply side, that these topics start to kick in. And I think then I'm afraid I'm here at, I would say, rather on the pessimistic camp, that maybe not to the degree we see it now, and maybe have a little bit increases, but it will not, in our view, they're very, there's a low probability that this will go back to low levels very quickly. So I think it will be a topic, and it's important for the ILS market and the reinsurance market to deal with it. We were fortunate that over the last, I would say, 10 to 15 years, inflation hasn't been a big topic. The only inflation we needed to take care of was really the climate change induced claims inflation, and otherwise I think this is now really what we need to get right to make sure we have an adequate pricing.
Absolutely, some very good advice there. So all of this macro effect obviously also has an influence on investor appetite as well, which is clearly an area that affects the ILS market. And one of the most sort of evident areas is, as usual, the catastrophe bond market, where information's a bit more available. And investors have exhibited a really strong appetite for improved returns, and this has been evidenced by the spread widening that's been seen. For your team, do you think this is making investing more difficult, or is it actually producing better opportunities?
I think on our side, I would say it makes things easier, but it's a bit a random thing. Why I'm saying that is, I think from our perspective is we have capacity available where there is probably a shortage of capacity for reasons I mentioned, like euro taking away some of the US dollar denominated capacity or reducing that. Our view is also that there was a significant supply of capital coming into the ILS market and cat bond market specifically last year and maybe even at the end of 2020, and we feel that is now deployed. And at the same time, I think there were a number of factors leading sponsors, new sponsors, or additional demand of new cat bond issuances into the primary market. And there was a bit of timing mismatch that now it seems like most investors already have allocated to cat bonds after, let's say, the last couple of years. At the moment, it seems like less capital coming in. And this is, Steve, this is nothing very new. I think when I try to remember 2008, when you really have high volatility in financial markets, investors are busy with all the major asset classes where they have 20, 30, 40% allocation. This is what basically makes the positive and the negatives of their portfolio. And ILS is maybe a little bit more on the sideline, or at least mentally. But I think again, is like on our side, it made it a bit easier because we really were able to pick and choose. Very attractive pricing, I have to say, high discipline in the market. That is very positive. Terms and conditions are good and improving always, and I think that is very positive. But I think on our side it was pure timing that we had this capacity available in this environment, which is good. And I also believe, and again, something we've seen historically is that once the financial market storm is over or is calming down, at least in the past, I think investors, they saw ILS is one of the very few true alternative investment strategies, low correlated. And I would not be surprised. There's an enormous repricing of risk and return at the moment. Think about fixed income. I mean, returns on the fixed income side over the last 10 years, equities, enormous returns. And I feel that this is at the moment a total reshaping of financial markets. And my personal view is there can be a very positive momentum when we get towards the end of that or when things are calming down. And I would not be surprised if investors will start to reallocate to ILS in a very significant way. Historically, we've seen after global financial market crisis, you remember that, Steve? That was one of the biggest growth times, and wouldn't be surprised if we see something like this happening in the next year or two.
Interesting. It certainly does make the whole thesis for the ILS market stand up when you see this sort of volatility that just spreads across everything else and continues to. Do you think the spread widening we've seen will persist? I mean, some people seem to think it'll tail off as soon as issuance slows down, but I guess later this year we should see some new capital flows into the cat bond funds again. Do you think spreads are going to remain wider than they were a year earlier, perhaps?
I'm a consistent pessimist. Perspective, I would say the main problem is the demand and supply timing and the demand and supply matching in the ILS market. And it is, I think, that the biggest driver of that is also the fact that it is still a very small market. So I wouldn't be surprised that when there are less issuers, less new issuances, there are more maturities, there's more capacity available. I think there will be, as you said, a tail off of the pricing. Unfortunately, I'm a big believer in that. However, and I think this is market dynamic, demand and supply. It is as simple as that. We already see it at the moment. I feel like there's a little bit like a tiny quantum more capacity available like the last couple of weeks and issuance. And I believe we can see it a little bit already. Now, I think I wouldn't be surprised if we see that. The other thing we shouldn't forget is it's a contingent risk, as we all know. But I also believe that if we see a significant storm or catastrophe this year again, or a series of events, I think that will have a further significant impact on the market. The returns haven't been great over the last couple of years. There have been significant events, and therefore I believe if we see something now, I think this is also going to dampen a little bit the supply of capital and appetite. And we shouldn't forget, I think if we oversimplify things, but a event from 2019, maybe even from 2020, could well be 30-40% more expensive today. So I would say it's a fragile demand, supply and pricing environment we are in. It can turn into both directions anytime. The reinsurance market, is my view, is it has less reacted than the ILS market. So it was, I would say, a smaller improvement of terms, conditions, and margins. But on the other hand side, I would say in the reinsurance market, I would expect that there is there is a consistency in terms of pricing increases over the next, I wouldn't be surprised, even 2 years. And again, it seems like a big topic out there is that reinsurers are less and less interested in the very volatile results of property catastrophe line of business. Think about the news about Axis pulling out. I mean, these are, I would say, signs of the time, and we saw a lot of companies, big companies, reducing that volatility. Reason for that, in our view, was that they felt that it is affecting negatively the multiples their stock is trading at. And that is why I think the reinsurance market, this change of dynamic and less supply of risk capital, I think will persist and will have a multi-year effect on rates. Again, capital market, pretty small, with a bit more than 30 billion, and a couple of billions more or less in one way or the other makes a big difference.
Absolutely, yeah. No, it's interesting that you think the reinsurance market has perhaps moved a little bit more slowly than the capital markets, which I remember we saw previously, I think around 2008 as well, that it was the cat bond market that seemed to move the fastest. So looking a bit more in depth at sort of what's happened around the mid-year renewals that we're still going through at the moment and have been particularly challenging for some. Perhaps you could talk us through maybe how you've seen the market move and also what you've been doing at Credit Suisse to sort of capitalize on that.
I think for us, the overarching topic is very much driven by the last 5 years and by the view we have formed on climate change and on climate change impact on the asset class and reinsurance catastrophe risk. Our view is very clear that we think that, and you mentioned it in the beginning, pricing cycle-wise, it seems like we are maybe back where we used to be in 2012-ish. And that's good. Don't get me wrong, I like it. But if you do the calculation and you look at climate change risk, you have to factor in a 2 to 3% climate trend claims inflation every year. And what that means is, looking back to 2012, you have a compounding interest rates on interests effect, and you're looking into an environment where to be flat or have the same margin risk adjusted as back in 2012, you already would need to see pricing levels 15+% higher. And I think this is not the case realistically. And what that means, and I think coming back to your question, how we view things is we have two ways to influence our margins and our expected margins. One, obviously, is premium. There we are part of the market. Yes, it's positive. We're pushing hard for higher premium. The second thing is level, basically deductibles and exclusions and what type of risk we cover. And here we have made very significant changes, and this is what we again have implemented in the mid-year renewals, is that we categorically exclude a lot of risk where we think perils, where we think there is a significantly higher annual rate of change due to climate change. We think everything which is somehow water related, be it flooding, hail, be it droughts, wildfire risk, we think these are the risks which have claims inflation even beyond what I said earlier, 2 to 3%, which I think is probably the right thing for hurricanes or typhoons. So risk where we see that trend going year after year against the peril and the margin, I think we generally exclude it. It doesn't mean we don't underwrite it. We invest into these risks, but we invest into when we see that a counterparty is prepared to pay for it. For example, there are, as you know, there are flood-specific cat bonds. We think it makes sense because that cedent is sitting on a lot of flood risk, so they have to pay for it. It's not like part of an overall protection. And I think that is a bit philosophy where we say where we get paid for it, we invest into. And otherwise, for us, the key thing is level, to make sure that we get the inflationary trend of 20-30% or even more if you add on the climate effect. When you look at these huge inflationary trends, we make sure that if we don't get enough premium increase, that we basically get rid of the risk by significantly reflecting the claims inflation on raising the deductibles. So I think this is really what we implemented and where we are extremely strict, be it on the cat bond market, be it on the reinsurance market. And that was really influencing our mid-year renewals. And I have to say is I'm fascinated to see that mid-year for me is an interesting renewal. If we put Florida aside, I think, which is almost a special topic on its own. But if we look at the different regions, you can look at the more regional buyers in the US, you can look at Australia. What you can see is consistently premium increases of deductibles across the board. And I think that's a very positive development. It's a development which is caused by a number of years with significant catastrophe losses around the world. And finally, I feel like the market is moving not just in one region and not in all the other ones. It's actually every region is moving, and that's a very positive thing. And I think that makes it also much easier from a portfolio construction perspective, is that you really can focus on where do you want to invest. And we've seen a lot of very attractive regional covers as well, as across the globe opportunities where you feel there is stress in the market. And as I said, probably less reinsurance capacity available. Given the shift of strategy, a lot of reinsurers have gone through over the last couple of years where they're reducing exposure on the catastrophe side. We start to see that now, which is positive.
Mm. No, it sounds like the market's really moved at this renewals, particularly in terms of terms and conditions. And we always talk about the headline number of pricing and rates, but actually terms and conditions are just as important in many cases. And I think historically the market made a lot of noise about things like hours clauses, but perhaps didn't make much noise when deductibles were shrinking all the time and multiple perils were being thrown into transactions. And it seems a lot of that's getting backed out, which bodes well for future portfolios as well, I would think. So I can't see those being sort of stretched further again in the future, I would hope.
I agree.
You mentioned Florida, something that we really can't not talk about, given that the Florida renewals are still ongoing in some cases, and we're now on the 16th of June when we're recording this today. So how are you viewing business in the state of Florida now at Credit Suisse, and do you feel the recently enacted reforms are going to make any difference at all?
I think the answer is I would say starting with the reforms, which came very late, and for some companies, I would say too late, unfortunately. I would say the reforms, they definitely bring something. The very key question is, does it bring enough? And our view is it brings not enough too late in the process. we still believe that the fundamental problem in the state of Florida around how claims can be inflated around let's say legal matters, we think that this has reduced, but it still is there. If you compare Florida after the reforms and you compare almost every other state, still this is different, and it still means there is a claims cost and will be a claims cost affiliated with that. And one of the problems I personally believe is that it's very hard to quantify that. It's almost impossible to quantify that risk, and I think that makes it a very challenging market to provide reinsurance or ILS capacity to. The second thing is when you look at where the market is today is it's actually at the level we thought it's gonna end up much earlier. The reason is the fundamentals are not healthy, and the fundamentals, they very much remember me of what happened in the mortgage market back in 2008 and the years before, is that if you look at the details, it's not a healthy market as a reinsurer or as an ILS player to participate in. One is all these legal claims inflations I mentioned, very difficult. Second thing is most of these companies are strongly undercapitalized with very little surplus. And they are 95% dependent on reinsurance. And the last bit is that they make a lot of money, not with risk taking and with underwriting. These companies, they make a lot of money with services and business concepts, which are not directly linked to aligned insurance concept with the reinsurer, that you could say eat your own cooking. They have a very different P&L driver than the reinsurers or cap on investors have, and that this is something we've seen developing over more than a decade now, and we always thought this is a very unhealthy combination. We were surprised that it took that long to basically materialize and demonstrate the underlying problem. But we are there now where we've seen, I believe it's about 8 companies going out of business-ish. A lot of companies still very low capitalized and with enormous reinsurance cost. And for us, the big question is what are the things which can go wrong? And we are just very concerned when you look at such a constellation and think about a couple of small, medium-sized events in the south of the US and part of it in Florida. This will massively eat into the retentions they have. And the problem is, I'm not that sure how well protected they are for frequency. And then also, if there is a medium-sized big event, how would the future look for these companies? They definitely are on the brink of not being able to afford the reinsurance premiums and the cap on coupons they have to pay. And that is why I think the next season is a very critical one, and probably every season will be a critical one, because I don't think it's going to fundamentally change. And we are still, if you think in life, what are the things which can go wrong, is like, usually you shouldn't expect that it's all the things you had on the radar in the first place. And we have a couple of thoughts in the direction that maybe the credit risk is not that low. They are, even with upfront premiums, we think there are scenarios where these companies could make huge cash calls reinsurers and from the cat bonds. Then that capital is they are permitted to do that. If they maybe do oversized cash calls because they have to serve their policyholders, and then that capital is commingled with their balance sheet, and then they go bankrupt, then investors or reinsurers would well have some residual credit risk. So these are the things where we are saying is like, do we want to be exposed to that? And the answer is not really. And it's always a question. It's a very difficult one because it's also, you could say, for reinsurers and ILS market participants, it's an opportunity now because premium have gone enormously over the last couple of years and also this year. So you could argue it is much more attractive, but I think we are maybe a bit different that we have never been very strong in Florida. So the rationale to say if you rode Florida the last 5 years or 10 years, you definitely should write it this year. It doesn't necessarily apply to us, this logic, and I would say I have some understanding for that logic. It makes sense, but it's not necessarily what we are confronted with. And again, it's more a fundamental view where we think if the underlying is not in a healthy marketplace, and for example, we did the analysis of, if you look at the primary insurance market and you look at the homeowner premium, you look at the modeled expected loss, and you look at an expected cost ratio these companies have, and if you look at claims inflation, you already are significantly running at the combined ratio in excess of 100%. So if the underlying market has a lack of premium dollars, it's very, very hard for reinsurers and ILS market participants over the very long term to actually have a sustainable risk transfer chain. And this is what our job is, we understand, is that we help to manage risk globally. But if you have a spot where there's not enough premium, you can do it for a year or two, but you can't do it for 20 years. And I think that is a bit why I think Florida, in our view, is and stays a very problematic place for natural catastrophe risk. But one could be of the opportunity. It's a big opportunity this year.
Interesting. No, you make some really good points there. Actually, it seems to me that the only way to solve Florida right now is to have another special session that really addresses the litigation issue once and for all, and just closes off that avenue, which unfortunately seems very unlikely to happen given the sort of the partisan basis of the political system down there right now. And with I think the next session of the legislature is in mid-May 2023, which is not really good timing for Floridian insurers at all. So with all of that in mind, begin to wrap up this conversation. It's obviously a good time in certain areas of the ILS market right now. There's a lot of attractive investments available, and you've been talking about the improvements in terms and conditions and things. But how do you intend to capitalize on the market environment for your investors at this time?
I think most importantly, I would say, is stay disciplined and try to even increase how specifically you cover risk and make sure you basically can charge for it. And I think from our perspective, the very important driver for the next 3 to 4 years is to get level and pricing right to deal with the enormous inflation. Because if you look at this inflation or claims inflation potential, if it happens, it's enormous, and I think that is very key. to have a strategy for that. And I think this is really what we try to do, and because we think that's going to be in this positive development, in this very positive development where we see we're coming out of a soft market. We've seen now a number of years in a number of regions of consistently better premiums, higher premiums, better terms and conditions, and as you said, also these discipline elements where you have exclusions, where you have increased deductibles, you don't have a franchise, but you have a real deductible, and so on. I think all of that, in order to, and come back to your question, in order to be able to capitalize on it, you need to make sure that you don't get caught by this macro trend, and you make sure you have, from a risk-adjusted perspective, a strategy adapting on that, because the claims inflation is a very significant, I would say, risk in current environment. And we shouldn't forget this. We think we at least have the glass half full at the moment. To say it in the positive way is, if we look at the last 5 years, I think when you measure cat bond defaults, we looked at that. If you look at how much defaults did we have, and I can't remember the numbers exactly now, but if you look at the modeled expected loss, it's roughly running at the 2.8% for the entire market, and the 5-year average annual default of cat bonds is probably about 2.6, 2.55-ish. So it's just a bit short of the modeled expected loss. But we have to see is in the last 5 years, yes, we have seen some significant catastrophes, but we haven't seen the one in the 30, 50, 100, 250 years. So what that means is that we need to push further for significant premium increases to make sure that we can deal with climate change, and now on top of that with claims inflation becomes very important. And I think I have to say it's a positive, I would say, last 2 years where the market turned towards discipline. And on a global scale is like Europe hasn't moved premiums for many, many years. Since 1999, or it actually only moved downwards. And even in Europe, we see very positive signs, which were probably a result of the very negative outcome of COVID-19 on business interruption and the big floods we saw last year. But that's good, because we need to see a global move. And that is why I would say we have a lot of work ahead of us, but it's a positive momentum. I think the floating element with interest rates increasing will help us as well. That's definitely positive, but there's a lot of work ahead of us to basically to manage those challenges we have.
Yeah, and some of those are challenges that obviously this market hasn't seen for well over a decade. So there's going to be a lot of people in ILS who aren't familiar with inflation, particularly, or moving interest rates. So it's going to make for a very interesting couple of years ahead, I think. So have you got any plans for new products or new fund launches at Credit Suisse ILS over the coming year?
At the moment, we're pretty happy with the products suite we have. At the moment, we don't have any plans on that. Again, it's probably more about implementing strategy, implementing discipline. I think that's the most important element at the moment.
Great. And then hopefully, as we look towards January 2023 renewals, do you just hope for more of the same and a continued trajectory?
I would be very surprised if we see like a turn of this trend. I think momentum will be very positive for ILS investors and the reinsurance market, also over 1st of January. again, if I would say, of course, if there are like 6 to 9 billion coming new capital to the capital market, we would feel it. But from a bit more wider perspective and without significant flows, I would say we are in a very good positive development here.
Great, thank you. Nice positive note to end on. Niklaus, really a pleasure to talk to you as usual. So thank you very much for your time, and I look forward to catching up soon.
Thank you very much. It's a pleasure.